This panel will discuss the role of the banking system, private credit investors, and ARCs will have to play to ensure that the Indian economy does not run out of the fuel to meet its ambitious growth targets. And for the same, I'd like to invite on stage the speakers of this session, Amit Agarwal, Head Stressed Asset Investment, Edelweiss Alternative Asset Advisors. Good morning, Amit. Welcome. Indranil Ghosh, Managing Director and India Head, Cerberus. He'll be joining us virtually. A very warm welcome to you. Kapil Singhal, Managing Partner, Private Credit True North. Good morning and a very warm welcome to you. Ameya Khandge, Partner, Tri-Legal. Good morning. Aye, please, come. Ishwar Kara, Chief Executive Officer, Kotak Special Situations Fund. Good morning. Please take your seats, sir. Nachiket Nayak, Head Corporate Lending, Arka FinCap, will do the honors of moderating this session. Good morning, sir. And I hand this over to you. Ladies and gentlemen, before the Honorable Moderator begins this session, I must request you all to please settle down and take your seats.
Okay. Thank you, everybody. And the title of the session reminds me of a very interesting dialogue which the Fed chairman, Ben Bernanke, actually made to the US Senate when he was begging of them to pass the TAR bill. And he said, credit creates an economy, but lack of credit can pretty much destroy it instantly. And we are pretty much in that ballpark where if you see over the last 2 years, and I'll spend a couple of minutes opening the session with setting the backdrop, we've seen initially demand to be pretty crunched given the pandemic and the uncertainty around it. And now hopefully we are beginning to see a good revival, and consensus seems to suggest that we might just be revisiting Capex Mahotsav, as some people are calling it. On the supply side, interestingly, we've had a spectacular run in the equity markets with all-time highs being hit. Very often people questioning why it was so, but so be it. On the credit side though, which is the other source of capital for companies, initial part rather muted, expected to be so with the amount of risk aversion that we saw. But now we are at that threshold where if you are seeing a confluence of expected growth and equity having played its part, the ball's in the court of the credit providers. And that's what we'll probably spend some time on, getting a sense from the esteemed panelists here by way of how are they reading into the situation. First, by way of the likely demand for credit, and then of course coming to the sources, where are things placed, one by way of the conventional sources, and then also by way of the newer platforms that a lot of the panelists kind of run and operate. So let me open this up by way of getting a sense from the panel, and we'll keep it as open-ended as possible, by way of getting a sense from them of where are they seeing things from a macroeconomic environment perspective, and then coming to sectors by way of certain key drivers of Indian economy, whether it's commodities, whether it's industrials, whether it's the clean energy, which has been the flavor of the last few months. The newer age platforms, are they credit ready? Are they likely to be off-takers of credit? So let me actually go, why not, offshore to Indranil and get his sense by way of his vantage point in Singapore, how he's seeing the India story unfold and what's it holding for people outside.
Good morning, everyone. Glad to be joining you guys remotely and hopefully next time in person. I think India remains one of the key economies that global credit investors or alternative investors are focused on. And definitely a market where most investors feel that the regime is such that one can operate various parts of the capital structure. The previous panel spoke about equities. The panelists here have participated in senior secured to sort of mezzanine to distressed lending. And we've seen over the last 5 years all parts of those capital structures being reasonably successful for investors, especially foreign investors, and hence we feel that India continues to offer a significant avenue for most foreign investors to continue investing further in the credit space. One of the things that Nachiket mentioned was clean energy, and that's definitely something that is of great interest to foreign investors. We've seen in the past foreign investors taking actually a lead in the space where they've sort of seeded a bunch of platforms which have now scaled up. They've been extremely successful, resulted in reasonable returns. And hence, foreign investors continue to be further attracted to the sector and continue to deploy, again, across the cap stack for clean and renewable energy. Why don't I pause there and pass it back to Nachiket?
The financial sector in India is concerned. So specifically to get your sense, given that the financial intermediaries pretty much funnel credit into end users, how are you seeing that space, one, by way of some of the existing platforms changing hands with players like y'all, and the sector in general by way of a credit demand and supporting growth point of view?
I think as far as the Indian financial services sector is concerned, it's actually gone through up and down phase over the last 3 to 5 years. And I think is now coming to the end of the tunnel where the light is clearly visible. People have either provided or resolved for distressed assets and have now sort of moved on and are slowly but cautiously restarting lending. And I think that's going to be actually, from a foreign investor standpoint, I think that's going to be a big challenge for us, given that we see banks and NBFCs will start sort of competing for the credit pie much more aggressively over the course of this year, which has been missing in the first half. But we also feel happy about it, given that the market sort of depth increases and it enables us to do more where our risk capital is more appropriately suited. We also think that transfer of some of these platforms to investors like us enable these platforms to get recapitalized and sort of get back to either resolution if this is a pool of stressed assets that are being passed on because resolution also ends up needing additional capital, cannot be done in a void. And also where platforms which are performing credit platforms are being transferred, hopefully foreign investors bring in further equity capital to sort of create much more investable capital across the space.
Let me now open it up to the investors on the panel or the credit providers on the panel and get their sense on the traditional sectors which have driven growth and credit demand in India. Call it commodities, call it industrials, call it infrastructure. So just open house, Ishwar, Kapil, Amit, your views on these 3 or 4 sectors.
Thanks. Hi, Daniel. Missing you around here. The way we have seen our fund play out, we raised $1 billion in 2019, largely to address the distress and special situation landscape, which at that time was pretty robust. But as we went along, we saw that either a large part of those NPLs have been resolved through strategic buyouts or through other financiers who have come in. And also, thanks to some delays in the IBC process, etc., that the market had soon changed. And credit, which was usually the structured credit, the wholesale credit space where NBFCs, credit mutual funds, etc., were playing a large role, they kind of had their own issues, and most of them have either closed down or they have gone slow and moved to the retail space. So this threw up a lot of opportunities for us. And as we speak right now, we've deployed around almost 90% of our total corpus. And of late, we see that the nature of the transactions are more in the growth and the development space rather than in the distress or the special sits kind of space. And with that background, we are on the road to raise our next fund. And we are looking to call it a strategic situation fund rather than a special situation fund. So I think that's the way the market's going right now.
Kapil, how are you reading? You all also are in the midst of closing your fundraise. What are you reading into investment opportunities? And again, any specific themes, sectors that you see appetite in?
You know, Nachiket, the way I feel about, let's say a couple of big picture comments on India and the way I've seen it evolving. And I speak from a credit perspective, not from a general. I'm no expert in Indian economy, but I do believe that having built a career over 30 years in credit, I can speak with some confidence on, how I see the credit market, emerging. The way I think about credit is there are two things that are definitely changed for India, and they're all for good. And I think that is the fundamental basis of why I've continue to be so bullish on Indian credit. One is there's a lot of criticism, Nachiket, on IBC, but the fact is this has given the comfort of any domestic or international investor to have a basic downside protection, which is the fundamental basis of giving credit. Till now, credit has been thought of as, as somebody described, I was meeting somebody recently has said that, whenever he feels like he'll give you the money back. That's how, mostly, sophisticated, savvy investors have thought of India as credit. IBC has put a fear of God in the minds of Indian promoters. It is still a long way to go, but it's one of the most seminal shifts that has happened in India. And I'm sure Amit, Ishwar are beneficiaries of this, as they have seen attracting a lot of money in the Indian credit market. So that's number one. The second is in terms of the second problem with the Indian credit market has been there were a bunch of governance issues that prevailed in the Indian corporate sector. And I believe that the way government, the way regulatory authorities, the way IBC is set in, the governance standards of Indian corporates are constantly on improve. What it has done is, it has given a lot of opportunities on the distress side for the last 3-4 years. It's given a lot of opportunities on the special sit side. We are seeing a lot of refinance opportunities coming out of the NBFC, mutual funds, and the banks. They were the three main components of providers of private credit or credit in the past. We believe the time is now for these, kind of segments to now move into the AIF sector. Primarily at the back of good governance standards, primarily at the back of IBC, and the events unfolding post ILNFS, post the Yes Bank, post a couple of mutual funds which ran into the problem. And structurally, we believe close to 3 lakh crore of supply in the private credit market has been disrupted in the performing credit side. And I think that's a huge number. If you look at the total funds, Nachiket, that are there today operating, a bunch of people raising money with us, but the total supply is less than 30,000 crores. So I believe it is set extremely right for the way the market is set up today, and we feel extremely bullish. In the performing credit category, special sit, real estate, distress, fundamentals of credit have been set right. I think that's most important. We'll love to play all the categories going forward in future, but we believe performing credit market in the current stage is set in the right space. Starting with refinancing, and as the capex cycle will pick up, this is going to be a lot of growth financing as well.
Okay, cool. Amit, you all run products by way of funds across various parts of the capital structure. How are you seeing each of these dynamics play out?
No, sure. I think in our understanding, credit is very important for the economy. And I think we have a fair bit of growth coming our way. And if that growth has to come in, credit has to play an important role. In my view, we look at credit in 3 large buckets. One is the traditional banking credit, then it is the shadow banking or the NBFC credit, and then there is private credit fund. Within private credit also we distinguish between performing credit and special situations. And I think each of them has a role to play. I think India today is having a sort of a very weird is not the right word, but it's a very strange yield curve where people with higher ratings get fairly cheap amount of capital. But even mid-market companies or slightly lower rated companies find it difficult to raise capital. And flexible capital is the need of the hour when you go for financing growth. while the traditional banking system is more attuned to normal credit. If you see, the mainstay of credit growth has been retail, which is, I think, almost double digits, 14% odd of year-on-year growth this year. Thankfully, the wholesale numbers are also reasonably good for December at 9%. But the fact is that if credit has to grow exponentially, then a large part of that will have to come from private credit, because the non-banking finance sector will only finance a limited amount of capital of type of flexible capital that we need. I think on the private credit side, yields will continue to remain a concern, because I think the private credit markets needs us almost a 400 to 500 bips spread from where the banking credit comes in, even on the performing side. Obviously, for special situations, the yields are higher. But even for special situations, today, the stock as it stands is in excess of $100 billion, which is not a small stock. So there will always be a requirement for special situations financing to basically recreate value in a lot of companies. And in India, to create infrastructure is very difficult. So a company which has created infrastructure, the best course of action for the banking sector and the economy is not to let those companies go into liquidation. So we see annually at least $5 to $10 billion of deployment across private credit in various spectrums. Obviously, the banking credit will be much larger and much higher, but again, it will be more towards the highly rated companies. That's how we see.
Sure, sounds good. Coming to the person who kind of has seen how this, what Kapil mentioned, if I can say, a change in behavior of borrowers fructify in the last 4 to 5 years. Amey, how have you seen this dynamic play out by way of how borrowers used to feel it's a luxury to repay debt to now feel it's more a sword on their head? What have been these legal changes? What have been these regulatory changes? Where are you seeing things kind of now settled by way of the environment, at least from credit being appreciated by the borrowers, or are we still some time away?
No, I mean, definitely. I mean, when Kapil was speaking, that probably resonated very closely with my own thoughts on this. Clearly now, the market is very, very different and very, very significant, seminal, as Kapil put it, right? We've got, I mean, there was a point in time where borrowers really, despite statutes like SARFAESI, DRT and whatnot and what have you, borrowers really had the upper hand given the kind of litigation timelines that people were facing, right? As long as you had status quo in your favor, you were basically negotiating endlessly with creditors. I think the two things that have changed are, I mean, there are 2 or 3 things that have come and sort of come into this confluence. One is, of course, the fact of IBC, where lenders are in the driver's seat. Point number 1. So that's a big negotiation shift. You may say whatever you want, and I agree with him that on the timelines or whatever, but the rules of the game have changed. Today, a borrower knows that he can lose his company come what may. And I think that alone will change behavior to a significant extent. The second very important thing, which has never happened before IBC, is everybody is on the same level playing field. You know, whether it was SARFAESI, other statutes, you could always pit one class of creditors against another. You know, certain kinds of credit will always be circumspect about coming in because they don't have the same set of rights. Now, IBC, whether or not you pursue it, has brought every creditor, whether secured, unsecured, domestic, you can come in through AIF, FPI, bank, and you're all on the same footing. I think, so, I mean, while it creates its own conflict amongst creditors, the fact is that this remedy is available universally, and it makes the supply of that credit so much, in a manner of speaking, easier for the borrower, because it's now just more bankable, right? So definitely, I think the third part is, of course, accessing foreign capital now. The regulatory regime has never been this favorable. You know, historically, you needed banks or NBFCs. You needed to be regulated entities in India. You had foreign sources of capital which are highly regulated through ECBs. Now, if you just look at the spectrum between the AIF window opening up, between ARCs being able to do more and more on the distress side, with ECBs becoming more and more liberal, today it is fairly easy to get foreign sources of capital in different currencies into India for a range of purposes which are much wider than were possible. So yeah, I think borrowers, the right borrowers have access to different pools of capital, different sort of, at different parts of the capital structure, depending on the needs. It's all there. And
Good. It looks like the honor of the contract is kind of falling into place between the creditor and the debtor. So that's always good to hear. I'd like to now shift on to the supply side by way of the platforms delivering credit and how they are placed currently. Before we come to the alternate platforms, I want to spend some time and get your sense on the more conventional and, if I can indulge and say, boring platforms of banks, bond markets, and probably NBFCs, the few that are still left on the corporate lending side. By way of how you see them, they were in a fairly risk-averse mode over the pandemic, and rightfully so. But are you seeing them far more gearing up to open up pockets to fund the growth that's likely? Liquidity, of course, is pretty awash, so that's something which the central bank has ensured. But are you seeing that risk aversion going away and hopefully their ability to step up to the plate coming back? So again, three of you all, what's your sense on each of these markets? Ishwar, with you first.
I think if you look at the credit offtake numbers, which have shown a decline actually, as a percentage of credit to deposit ratios have come down. Also, if you look at the ratings of the corporates who have actually borrowed, more than, I think, close to 97, 98% is only to all the AAA rated. So it is a very bipolar. So while credit is available, money is available, but it's going only in the direction of the superior, so-called superior high-rated paper. So then what does the rest of the market do? So the rest of the market is where the NBFCs used to play a very large role. The debt mutual funds also used to play a very large role there. But with them going very slow, I think that's where the key opportunity will come in. And that's where we come in. And that's, as Amit said, there's a 5% arbitrage over there. And if you were prepared to take some kind of equity risk as well, you can bump that up by another 5%. And that would give us the kind of hurdles that each of us in our respective funds look for.
Okay. Kapil, you have been a part of an NBFC before, your current avatar. How do you see their role kind of evolving and settling in this new day?
Indulge me, this answer could be a little longish, because I've lived an experience of almost, couple of years in a largish NBFC, plus, we are in the fundraising mode now. We've been thinking about what's happening in the market. The way I think about Nachiket is that NBFC model and then subsequently mutual funds have supported the growth of private credit in India. There's nothing wrong with it. I mean, as you're developing a country, as you're developing an economy, somebody has to support. You can be all critical about it, say that, they were not the right structures. But the reality is that has given a fillip, and we've created a 3 lakh crore kind of financing between the NBFC banks and the mutual funds. The fundamental mistake, I think, which happened in the NBFC, Nachiket, was the fact that it is a levered, it is a rated, and it is a regulated vehicle. And what it does is it creates wrong incentives for the well-meaning, good managers sitting in NBFCs to do the wrong things. There's nothing wrong with the people who have managed those businesses. It is very simple that when things go wrong, the fundamental basis of credit is you need to take action. But instead of taking action, if one starts to think, what is it going to do with my rating? What is it going to do with my leverage capacity? What is it going to do with my regulatory capacity in terms of what my net NPA ratios are? And I've seen this and I've lived this. The reality is, structured credit, nuanced credit, anything which is out of ordinary, anything which doesn't repay on time, should never have been done in regulated vehicles. It should have been done always in flexible vehicles where you can protect downside by taking quicker action, where you have the right incentives. Look at where we are today. We have 3 lakh crore of supply which has been impacted. Even before that, before we go to the big picture numbers, the second problem was the NBFC models evolved where all of them wanted to list. So the zeal to create asset books, the zeal to create higher AUMs was a supreme kind of need for the hour. Look at the way they borrowed, or they raised money from their for deploying in assets. They borrowed from the bond market, they borrowed from the bank market, and they borrowed from the equities. That's the 3 sources of capital. Equity was a flexible capital, and there you could deploy anywhere you want. From any money that came from equity, you could do any structured trade. Bank was fairly inflexible capital. So look at the whole behavior. You borrow from banks, you are an NBFC, you're regulated, and then you go and deploy in non-bank assets. Third was a more flexible form of capital, which is bonds. Bond market is today shut for NBFCs beyond any corporate-backed NBFCs. People are saying that unless you're a corporate house, I'm not going to give you many beyond 3, 4, 5 years leverage. Maybe the good times will return where you'll be able to raise cheaper financing, because that was the fundamental basis of an NBFC model. Leverage the book, live with the regulated issues, and lend cheap and create a larger book. I think that model is finished. Where we are today, the NBFC model is going back to being a liability model. They will take risk on the asset side, they will do small trades. Two of the largest NBFCs today, which we kind of deal with, their maximum ticket sizes on individual corporate trades are less than 50 crores. They can potentially write a 1,000 crore check given their SBLs, but they are doing less than 50 crores. So while NBFCs are coming back to the market, but they're not coming back to market in a meaningful way. And Nachiket, you and I have spoken about this several times, that the way to then do the NBFC market lending is to form a club and keep the exposure size small and then do this financing. I don't think anybody's going back to the era of booking a $100 million trade in NBFC. It's not going to happen. Mutual fund markets, you look around who's raising money today. Some of the AIFs, some of the manager entities of the mutual funds are today in the market to raise money in the AIF format. They've become very clear that an alignment structure where a single bad news can, in a newspaper, can create a run on the mutual fund is not the right structure. I don't think mutual funds did anything wrong, by the way, in terms of asset quality. What they did wrong was the fundamentals, booking structure of that entity. And I think this is exactly the point I was making earlier, that stage is ripe today for an AIF. It's going to take time. But today, if you look at the number of AIFs being raised today, I think we are very excited by that.
Perfect. I mean, bond markets, they were always meant to be the promise and the balance, if I can call it that, of the banks. Have they been able to play credit? Were they the right places to play credit, especially after the 2-3 episodes that Kapil mentioned? Today, are you seeing them meaningfully play credit? Where do you see them supporting the system from a growth point of view?
So when we talk about bond market, I think we talk about the entire spectrum of bonds, right? From retail bonds all the way to a private credit or a special situations bond. And again, the range is fairly wide. I would say that, as Ishwar rightly said, that 97% plus funding is to AAA rated corporate. For them, raising the bonds is not a big challenge. The real bond market will come when the depth is there across rating spectrums. And that will happen only over a period of time. That has not happened as yet. If you see, the entire private credit business is happening through bonds only. Most of the investments are either happening through, let's say, a pass-through certificate, or happening through a direct NCD or convertible bonds in some cases. But there is not enough liquidity in that system. And it becomes very difficult to underwrite companies as a bond market investor. And I'll give you an example on a no-name basis. We had a corporate which we had financed at a fairly high double-digit rate. And over the last 5 years, they have kind of come out of the shadows and they have continued to be with us because of flexibility. We wanted to sell that bond off in the market. And we found only so many buyers interesting or excited about that bond. And finally, we were able to sell 1/3 of the bond out in the market at fair price. But the fact is that if I put that on the exchange, a good company, 1:3 debt to equity, good sector, will that bond automatically get traded? I think the answer is no. So I think it's still a very OTC market, a very 1:1 market for sell down of these credit bonds. So only when the market expands, when there is enough information, the exchanges, the listed exchanges, the rating agencies are doing more, the bond market is doing more, and it gets a depth. That is when real junk bond market, as I would say, could potentially get established. And that is some time away, in my view.
Perfect, thanks. Indranil, FPIs have been fairly active, both on the single-digit pricing side, especially given what's been happening on the soft interest rates globally and on the forward curve. Do you see that dynamic continuing, given the fact that global interest rates are likely to rise, and with the whole conflict situation, currencies seem to be in turmoil? Before coming to, of course, the alternate credit, like where funds like y'all perform, just wanted your sense on more the rate-driven investing that FPIs have been doing.
Yeah, I think as far as FPIs are concerned, interest in the India markets will continue to be fairly strong. And in fact, if anything, a lot of special situations investors like us are now going to slowly start doing growth credit, as well as low single digit, higher quality financing. And that's a space where if you look at what's happening with global alternative asset managers, right, who are trying to sort of grow their AUMs, they've realized that special situations is a great place to be in terms of IRRs that you can make. But opportunities in today's environment, where the world is flush with liquidity, still flush with liquidity, is few and far between. However, they have also found markets, India being one of them, where they have gotten comfortable with the local dynamic, the regulations, the way resolutions happen, and they have had the opportunity to look at a host of counterparties and come to a conclusion as to who they like and what segments they want to play in. And hence, we think that a lot of FPI interest will continue. The traditional guys who were doing the high quality stuff will continue to focus there. I think green financing is a big avenue for FPI who want to check the ESG box, and no better country than India, where growth and clean energy growth itself is pretty robust. Also, alternatives like us will now start doing financing for both growth and also for opportunities where the traditional banking sector is probably restricted from providing financing, or has to form a consortium to fund a big project vis-a-vis someone like an alternative investor who can potentially write a fairly large check as a single sort of counterparty, which brings additional flexibility to the table. So I think as far as FPI flows are concerned, despite the increasing rate environment globally, which will obviously translate into some pricing adjustments locally as well, we will continue to see significant participation from FPIs.
If growth is coming back, do you see the change in the nature of deployment of fundraise now moving from picking good value to now actually supporting new money or genuine growth?
I think each fund will have its own way of investing, and as I said, all the markets are large enough. Today, I don't think there is too much dry powder on the special situations side. I think overall, even if we look at all the focused India funds looking, I don't think there will be even $5 billion of capital chasing the opportunities on an annual basis. And while the stock could still be 100 billion plus, as I said. So I think people will keep finding interesting opportunities. Are there size? If you talk about size, the size of opportunities is larger towards growth and capex oriented opportunities. You could do maybe even $300, $400 million deals. But on the stressed asset side, deals in the range of 50 million to 150 million will continue to come into the market. And focused funds like us, we are raising another $1.5 billion fund, anywhere between $1 to $1.5 billion. And deploying that over a 3-4 year period time is not very big challenge, because as growth happens, NPAs also happen. I think they're necessarily a byproduct of a very fast growth. And since funds have 4-5 years of horizon for investing, getting opportunities is not a problem in that state. Having said that, I think performing credit will have its own special opportunities. And all this bucket is, as Indranil rightly said, is what traditional banking cannot cover. and what, let's say, the NBFC sector has now completely vacated either the space or reduced participation in that space. So yes, this will continue to be a largish opportunity.
Okay, good. Kapil, you've, again, just in the midst of closing your fundraise, one is traditionally a lot of alternate credit has been supported by offshore institutional LPs. Just wanted your sense that given a large part of your fund is domestic, smaller ticket money, if I can call it that, do you see that constituency of domestic non-institutional LPs or hopefully institutional LPs domestically beginning to get far more attracted towards these alternate credit platforms?
So from a domestic, I think the question is around whether we are getting enough interest on the domestic LP side, right? My two bit on this is, if you look at international landscape, and I'll just try to correlate that with the domestic landscape, the largest deployers of money are pension funds, endowment funds, insurance companies. And if you look at the way, and if you think about it, I mean, the fundamental question that has always bothered me is why the same set of guys do not finance the domestic, why that they don't comprise the domestic supply. And the answer lies in the fact that the government has been very careful in regulating these institutions and allowing them, or not allowing them rather, to kind of deploy in riskier assets. And the more I see, if you look at the way insurance regulations have moved, the way pension fund regulations are today moving now, I think the government is making all the efforts to make sure that it is enabling the boards and the management of these companies, these pension funds and insurance companies, to invest in these asset classes. The bigger question, Nachiket, remains is whether these guys, the managements of these companies, are still ready to invest in these asset class. And what is the track record? What has been their past experience? What are the learnings and what are the kind of, let's say, bad experiences that these institutions have had? Having said all that, I think on the whole, my experience in the last 12 months has been that there is a general kind of acceptance of this asset class in the domestic institutions, especially the insurance companies. And we've got a lot of traction from insurance companies. We believe even the pension funds, going forward, as the pension fund market develops, as, I don't know how much, you're aware, but what I understand is pension fund is today growing at about 20% per annum. It's a huge, you could be having a third of supply coming from a doubling of the entire pension fund market in the next 3 years. So I believe there is a whole world that is emerging in the domestic supply of institutions, and that again is a big area of kind of excitement and enthusiasm for us.
Okay, yes, cheers to that. Ishwar, the ARC model, given that now we have a national bad bank and we've got a change in regulation where now another category of AIFs has come into the picture, what do you see by way of their value addition, if I can call it that, or business model that they can cater to going forward in light of the change environment?
Yeah, Nachiket, I'll take that, I'll break that down into two parts. One is the NARC. So the NARC per se has been formed to take care of the larger assets and also in helping, aggregation of debt. So the way I see it as an AIF is that he is actually going to be a great, boon for us. Because the biggest problem, which I can see Amit smiling, is it takes us at least 2 years for us to aggregate debt. And it's quite difficult to be sitting over there negotiating with each banker all the time in consortium meetings. And I see the NARC helping us a great deal in doing and achieving this, because they will act as an aggregator. They would pick up this debt at whatever clearing valuations. And then people like us would then bid for these assets and then provide resolutions and solutions either in the form of growth capital or one-time settlements, or we could do structured transactions in the sense that you allow the NARC to continue with that asset on the debt side, restructure the debt, right-size the debt, and we come in for growth either in the form of equity or structured debt or plain equity, mezz debt. We could play across the capital stacks. So therefore, I see the NARC as a great boon for us, and we are really looking forward to engage with them. The second is on the other ARCs. I think that's what you want me to address. The other ARCs will find their own space. They have been active. and with the new regulations which allow AIFs and other body corporates also to acquire debt, water will find its own level. There was always a dearth of capital in that industry, and I would see, most of the ARCs moving into the retail segment. And as we see it right now, the arbitrage on the 1585 scheme, etc., has all gone. Today, it's become more of a cash market. Some NBFCs, of course, continue to be selling to ARCs on 1585 basis, but I think that will also, go away, and it will become a largely cash market. The ARCs, that is apart from the NARC, will play the retail and the smaller ticket space, whereas the NARCs and the funds will start, picking on the next cycle of NPLs that we create.
Yeah. Okay. Wrap-up comments. First, comment to you and to Indranil. Anything you would want to see different from a legal or regulatory perspective to ensure that this time round we don't revisit issues of the past? Amay, first to you and Indranil from a legal and regulatory perspective. Yep.
Yeah, I mean, very quickly, I'd like to see stability and predictability. I think that's my takeaway. I mean, we have these avenues, for example, the unavailability of VRR, for example. We've got the route, and for suddenly 5-6 months blindsided, you don't have the route available. So stability and predictability, I think, will go a long way, even on the existing set of regulations.
Indranil, from your side, from offshore, anything that you would want different?
So I think we are making reasonable progress. One of the things you mentioned was AIFs for special situation funds. While that regulation is quite encouraging, there are still certain issues which kind of render them difficult to use for foreign investors. Similarly, GIFT City regulations evolving, that's an interesting space that we are sort of watching out for. But for all of these, I think we need to have a couple more rounds of iteration so that these become actually usable routes. And hopefully we will see the regulators and the government kind of act on these suggestions that have already been put up very quickly.
Last question to the three gentlemen on the table here, on the dais here, sorry. They say we are revisiting the golden era of 2004-07, right? With abundant growth, if I can call it that. Unfortunately, people tend to forget that that was followed by 2008 and the three dreaded words of GFC. Any advice to both borrowers and lenders so that we don't, again, revisit ghosts of the past? To all three of you, so take your pick.
No, I think the only advice would be to just keep your leverage in check. I think that has been the bane. Because you can have events which are outside of your control, just like the Russia-Ukraine war, sending the commodity prices and so the working capital into tizzy. So keep your leverage in check and don't basically make capacity expansion plans in a way that all capacity comes again together and hits the market and there's no demand at that point of time. So I think just a fair assessment is helpful and just keep things in more context.
Kapil?
I'll again speak a little more thematically from an investing fund manager perspective. The biggest pressure a fund manager faces is, what is my peers doing? How much are they investing? And why am I not doing the same thing? And that is the pressure I think all of us need to take care and make sure that we do the right things, despite all the growth that is happening in the market, and we do end up doing the right things. The second reality, Nachiket, in the market is that we are all in the third-party business. We are no longer investing out of our prop books. A mistake that I make is going to impact the issuers raising or Amit's raising. They are bigger guys, but even what mistakes they make is going to impact the entire market. So I think if, as a community, we meet often and we do all the right things, we end up doing something good for the industry. Is what I would want to take away from this conference.
Oh, okay, great to hear. Ishwar, last words to you.
Yeah. Learn from your old mistakes. Don't repeat them. There are always room to make new ones.
Here's to new ones then. Thank you very much, panelists, and thank you for the crowd for the engaging discussions. And like I said, hope we revisit the 2003-07 era and don't end up in the 2008 era. So over to you. Thanks for that.